Money, as we know it today, wasn't always the way people exchanged goods and services. In fact, its origins date back to a much older era, where bartering was the currency of exchange. This system was based on the need to trade one good for another. For example, if a farmer had grain but needed tools, they could exchange a certain amount of grain for the tools of another. But what were the problems with this system? Exchanges weren't always fair, as they depended on each good's perceived value. Additionally, it wasn't always practical, especially when people didn't have what they needed at that exact moment. This led to the need for something that could facilitate the exchange of goods more efficiently. This is where the concept of money comes in. Initially, many cultures used items with intrinsic value as a medium of exchange. For example, in some regions, seashells, precious metals, livestock, salt, and even cacao were used. However, these items had limitations. Not all goods were easy to transport or store, and they didn't always have the durability to ensure their long-term use. Plus, their value varied depending on cultural context or geographic location. The transition to something universally accepted as money began when the first coins were introduced. It's believed that in Mesopotamia, over 2,500 years ago, the first metal coins made of copper were used. These coins not only made exchanges easier, but they were also more portable and storable than other valuable items. The standardization of their weight and shape helped ensure they were accepted equally in transactions. As a result, metal coins became the most common form of money for centuries, allowing economies to grow and thrive. Over time, civilizations began minting gold and silver coins, materials that maintained intrinsic value due to their rarity and durability. In ancient Greece, Rome, and later China, these coins were a symbol of economic power. Merchants and cities began to rely on them for trade, and coins became not only a medium of exchange but also a tool to showcase the power of an empire. At this point in history, money was beginning to resemble what we know today, although it was still based on a physical system. The evolution of money didn't stop there. As economies grew, it became more difficult to transport large amounts of metal coins. Plus, the need for a faster and more convenient way to exchange goods became urgent. This is where the development of paper bills comes into play. In China, around the 7th century, the first paper bills were used as a means to facilitate trade. These bills didn't have intrinsic value like gold or silver coins, but they were backed by the government, which gave them trust and credibility. These bills were the first step toward creating modern money, as we know it today. As paper bills gained popularity, banking systems began to develop more and more. Banks started issuing bills backed by reserves of precious metals like gold, creating a more complex relationship between money, the state, and financial institutions. This is how the concept of fiat money was born, meaning money whose value isn't based on a physical asset like gold, but rather on the trust and stability of the entity that issues it. The shift to fiat money was crucial for the development of the modern global economy. It allows nations to print more money to fund projects without being limited by supplies of gold or silver, but it also introduces challenges like inflation and interest rate management. These are key concepts in the financial world, and understanding them is essential to grasp how money is managed today. So, why is money so important in the modern economy? To answer this, we need to understand the central role it plays in the exchange of goods and services. Money acts as a medium of exchange, meaning it's accepted by everyone as a legitimate form of payment. This allows individuals and businesses to conduct transactions more efficiently. Instead of searching for someone who wants to directly exchange what we have for what we need, money acts as a conveyor belt that facilitates the flow of goods and services. Furthermore, money also functions as a unit of account. This means it allows us to measure the value of goods and services in a standardized way. Without this ability, it would be incredibly difficult to compare the value of different products. Imagine trying to figure out how many sacks of grain are worth a sword or how many horses are equal to a building. Without money as a unit of account, buying and selling decisions would be far more complicated. Money also serves as a store of value. This means that people can save money and expect it to retain its value over time. Without this property, saving would be useless since the value of goods would constantly change. However, inflation can affect this store of value, diminishing the purchasing power of money over time. Despite the risks of inflation, money remains one of the main vehicles for saving and one of the most accessible ways to accumulate wealth. Lastly, money serves as a means for investment. Investors use money to acquire assets they expect to generate returns, such as stocks, bonds, or real estate. These investments help move money through the economy, generating more jobs, innovations, and economic growth. Without a functioning monetary system, there wouldn't be enough capital flow to fund these investments and long-term projects. The history of money doesn't end with the introduction of coins and paper bills. In fact, the concept of what backs the value of money has been one of the most debated aspects throughout financial history. For centuries, coins and paper bills were backed by precious metals, primarily gold and silver. This system was known as the gold standard. Under this model, governments kept gold reserves and could issue bills with the commitment that these bills could be exchanged for an equivalent amount of gold at any time. In this way, money maintained its value because its supply was limited by the available gold. The gold standard provided significant economic stability, as it limited the amount of money a government could print. This helped prevent runaway inflation and maintained confidence in the monetary system. However, during the 20th century, the costs of wars and the financing needs of governments began to make this system unsustainable. In 1971, the United States, under President Richard Nixon, finally abandoned the gold standard, marking the end of a monetary system that had dominated the global economy for over a century. From that moment, coins and bills were no longer backed by tangible assets like gold or silver, and the concept of fiat money began to take shape. Money whose value doesn't derive from a physical backing but from the trust that individuals have in the government or issuing authority to maintain its value. In fact, fiat money is now the dominant form of exchange worldwide. Even though it isn't backed by gold, its value is still accepted by everyone due to faith in the institutions that issue it, like governments and central banks. Fiat money is essentially a promise. It's a promise that you will be able to exchange it for goods and services in the future. Trust in the banking system and economic stability is what keeps the value of circulating bills and coins intact. For example, the US dollar, the euro, or the Japanese yen have no intrinsic value themselves, but they are accepted as mediums of exchange because the economies backing them are strong enough to guarantee that the money remains useful. While fiat money has simplified the global economic system, it has also created new challenges. The concept of inflation, for example, is more relevant in a fiat system. Inflation occurs when there's a widespread increase in the prices of goods and services, causing money to lose value over time. Throughout history, inflation has been a recurring phenomenon that has affected entire economies, reducing people's purchasing power. That's why understanding how the value of money can fluctuate is crucial for managing your finances effectively. The relationship between the supply and demand for money also plays a critical role in the economy. When there's an excess of money in circulation, prices tend to rise, creating inflation. Conversely, if there's a shortage of money, prices can fall, and the economy could enter deflation, which can also be problematic. Therefore, central banks, such as the US Federal Reserve or the European Central Bank, have the task of managing the money supply and interest rates to maintain economic stability. Another key concept in a fiat money system is debt. Since money is not backed by a physical asset, governments, companies, and individuals can borrow money with the hope that its value will remain stable in the future. This has allowed the global economy to grow, but it has also created unsustainable debt levels in some regions. Managing debt is one of the biggest challenges in personal and governmental finance, as it can create long-term financial burdens if not handled properly. But how do we know that money remains valid in this system? The answer lies in fiscal and monetary policies. Central banks play a crucial role in maintaining the stability of fiat money by adjusting interest rates and controlling inflation. For instance, when inflation is high, central banks may raise interest rates to discourage spending and investment, reducing the amount of money in circulation. In contrast, when the economy is in recession, banks may lower interest rates to encourage spending and investment. In summary, fiat money is the foundation upon which the modern economy rests. It is not backed by precious metals, but by trust in the institutions that issue it. And although this system has allowed for unprecedented economic growth, it also poses risks and challenges, such as inflation, debt, and the need to maintain confidence in the institutions that manage the money. As fiat money took hold, the world began to experience technological advances that would further change the way we handle transactions. Credit cards and checks were just the first steps toward the digitization of money, but the true revolution came with the rise of cryptocurrencies. Cryptocurrencies, led by Bitcoin in 2009, not only challenge the traditional banking system but also propose a new way of viewing money in a digital world. Cryptocurrencies are decentralized digital currencies that operate without the need for a central bank or issuing authority. Instead of relying on a financial institution to validate transactions, cryptocurrencies use a technology called blockchain. This technology ensures that transactions are transparent, secure, and verifiable, without the intervention of third parties. The blockchain is a public ledger of all transactions made with cryptocurrencies, and its decentralized nature means it cannot be manipulated by any central entity. The emergence of cryptocurrencies has completely transformed the way we understand money. Instead of being issued by governments or central banks, money can now be generated by an algorithm and used globally without relying on any financial institution. Bitcoin, for example, is a cryptocurrency based on a decentralized consensus system. People can mine Bitcoin using powerful computing equipment, and its supply is limited by design, meaning there can't be uncontrolled inflation like with fiat money. The impact of cryptocurrencies isn't limited to money itself. It has also created new forms of investment, such as the market for non-fungible tokens, NFTs, and has given rise to an entirely new financial ecosystem. Cryptocurrencies and blockchain technology are also challenging the traditional structure of banking systems and have opened the door to concepts like decentralized finance, DeFi, allowing users to participate in financial activities without the need for intermediaries. However, cryptocurrencies also present several risks and challenges. Their value can be extremely volatile, generating huge profits but also enormous losses. Additionally, the lack of regulation and the potential for use in illicit activities have led many governments to consider regulating or even banning them in some cases. Despite this, the rise of cryptocurrencies is a clear sign that money is changing. While fiat money remains the predominant form of exchange, cryptocurrencies are gaining ground and could be the currency of the future. So, money continues to evolve. From a barter system to physical coins, then to bills backed by gold, and now to the digital age with cryptocurrencies. Each stage in the evolution of money has come with its own challenges and opportunities, but one thing is certain: money will always remain an essential tool in our lives. No matter how it looks or how it's handled, money is a reflection of the trust we have in the institutions that back it and the global economic system.